let's understand how human instincts works. In this lesson, we learn about human instincts. One might think that we, as people, react on the basis of experience and knowledge, and while this is true, we also react on pure instinct, and that instinct is present more than anything else in the stock market. As for the stock market in the short term, below 3 to 4 years, it is important to understand that the investors follow the instinct of Mr. Market. In other words, investors react on emotions and people are chasing prices, not value. Warren Buffett has strong opinions on market psychology. He is quoted to say, "Be fearful when others are greedy and greedy when others are fearful." In other words, what he means is that an investor should accumulate shares when prices are low and sell, or at least not buy when prices are high. We learn about a value-based approach to investing. That is when you look at the financial properties of a stock and have a firm idea of its intrinsic value. A value-based investor's mindset is to profit from accumulating stock. The larger the discrepancy between price and value, the more wealth you can accumulate over time. It is a buy and hold strategy. On the contrary, we also learn about the emotion-based approach that is only based on the perception of the stock, but has no reference to the actual value of the stock. An investor that bases his investment decisions on emotions ends up trading stocks. He typically ends up with fewer shares bought at a higher price. It is a buy-sell strategy. A prime source of different approaches to stock investing, which I personally read and enjoyed, was The Neatest Little Guide to Stock Market Investing by Jason Kelly. In addition to a detailed overview of stock investing approaches, he also provides a simple tool for composing a watch list for the stocks you consider buying. Be sure to check out the reviews on Amazon to see third-party endorsements and concerns before simply taking my recommendation. Greed cycle. When people think that it's easy to make money by entering a market that has been increasing for a long time in the anticipation that it will continue to increase, they are not looking at the value of the stock, they only observe that the price has a history of increasing. This is known as the greed cycle. Fear cycle. When people see that the market is dropping and start to sell their own stocks, the mindset is centered on the fear of losing money in the short run, and not whether the price of their holdings is lower than their value. Value-based approach. A value-based approach is an approach an investor adopts when he estimates the value of a stock and buys it at a cheaper price. It is a buy and hold strategy that accumulates shares of a low price and high value. Emotional-based approach. An investor who adopts the emotional-based approach has no estimation of the stock value. This investor buys stocks based on his preference and perception that might not have any relation to facts. He buys and sells stock arbitrarily and typically ends up with fewer shares bought at a higher price with a low value. Thanks for watching.